Hi, good day. Thanks all very much for joining us at this Q4 investment update. My name's Tom Merchant. I'm a partner and business development manager, and I'm delighted to be joined by Charlie Amber today, our co-chief investment officer. Hi, Charlie.
Hi, Tom.
Hi. So Q4, I think unsurprisingly, those of you listening in wouldn't be shocked to know that majority of sort of the focus around the headlines, and frankly, a lot of our clients were focused on the US elections and sort of the Trump winning for a second time and it being announced. Now, was this a surprise? I'd be really interested from your take on it in terms of sort of how did the investment markets react, and was this sort of a shock, and did they act accordingly?
Yeah, I mean, it was a surprise in the sense that it was a very balanced election going into it. In the build-up, especially the weeks preceding, Trump seemed to take a bit of a lead in the polls. Now, the efficacy and accuracy of those polls can be debated, but it felt like markets were beginning to sort of believe that Trump could get a second term as we sort of headed towards the election day. On the results, the US market reacted very positively, especially in the more domestically focused stocks, some of the smaller names. Um, Bond markets also initially reacted quite positively. However, since then, some of the moods changed. I think there's been a fair amount of taking stock. We've obviously since had his inauguration, but it wasn't in Q4. It was at the start of January. But what's become quite apparent is Trump feels a lot more empowered this time round. Is already putting through a number of policies, is touting tariffs to a much greater extent, and we are entering a world of sort of quite considerable uncertainty regarding sort of political impact on markets.
Fine. And then sort of away from the US, if you would, and I'm quite keen to talk a little bit around sort of how we're feeling about going forward, but just sort of looking backwards for now, did the rest of the world react positively? Sort of were equity markets in general up? How were they sort of behaving in Q4?
Yeah, it was a mixed bag. The I think the sort of the countries which were impacted most negatively were the ones that were in the sort of eye line for tariffs, especially from the Trump administration. China was one of the places which, following the end of Q3 at the end of September, there was a very strong rally in China based on um, the potential for significant stimulus. That had sort of faded towards the start of the election, and then once the results were announced, there was a sort of another nail in that led to a pretty muted growth in sort of emerging markets. I think global growth is definitely under threat from tariffs. However, a lot of the sort of Trump policies that we'd expect to see come through potentially are quite market friendly. So it really is a two-sided coin when it comes to his presidency over the next 4 years, especially in regards to sort of deregulation and being quite a pro-growth, pro-capitalist type president.
Fine. And while it seems like a bit of a redundant thing to say based on market cap and how sort of much US has dominated sort of the investment markets going forward, but is it safe to say they are still the number one driver in terms of sort of how investments and equities are behaving at present in terms of what's happening over there?
Yeah, absolutely. I mean, if you take the attribution or sort of contribution to returns from the either the MSCI World or just the specific S&P 500, you are still heavily led by what's sort of considered the Magnificent Seven. There were some sort of warning shots over the last quarter. News of DeepSeek, the sort of Chinese-led AI tech, was definitely a sort of well-timed shot at the Magnificent Seven sort of oligopoly, or the AI oligopoly that we've seen over the last 18 months to 2 years. It brings into question the profitability, I think, of the amount of capex that's been going on in these companies. A question that probably won't be answered in the near term. But if you've been investing a lot in data centers and infrastructure based on a sort of assumption that they're going to be highly profitable in the future, particularly a sort of scarce resource, and someone announces that they've got technology that doesn't require that level of infrastructure, you could see why it would be a concern for those companies.
Definitely, and full marks for using oligopoly in a sentence. That's probably the first time I've ever come across that outside of a book. Right, that's really interesting, Charlie. And so that's sort of a main look at what's going on in the investment markets. But if we sort of go on the other side of the coin, or the other side of traditional investing coin, if you like, and look at sort of bonds and debt, which traditionally has been the sort of uncorrelated asset class to be in, sort of to balance out the equity side. But as we both know, this quarter in 2022 and such like was really detrimental in that field. So can you maybe cover off a little bit what happened in the bond market globally, and whether the effects of the sort of equity market was still correlated to it, or was it behaving slightly differently?
Yeah, of course. So the bond market is slightly less dominated by the United States. It is still a major player, the Fed, and their cuts and decisions to cut do impact sort of global bond markets, especially emerging. But there is a more even spread. So I'll touch off sort of geographically how it played out. A few weeks after Trump's election was announced, the Fed came out and basically sort of implied that his term was most likely to be more inflationary in the States, and that would therefore be offset by a less dovish approach from the Fed. So less rate cuts. The equity market reacted quite poorly to this. They had a bad December. This was because prior to Trump's election, there was a real feeling that the next sort of growth engine for equities or for risk assets would be this falling rate environment. Part of the reason why you've seen a sort of a failing in the correlation or the low correlation of the two assets is the fact that inflation remains quite high. Historically, the two asset classes, equities and bonds, have a good level of low correlation when inflation is low. What we saw in 2022 was inflation spiked. Rates are the way to, or interest rates are the way to sort of curb that inflation, but they also caused higher rates, taper growth. Now, what we saw with the last few months is, because inflation remains above target, especially in the United States, when we have CPI prints or inflation prints that seem sticky, you get a Fed that comes out and says, well, we're not going to be able to cut, I'm afraid. We're most likely going to have to hold. Now, equity markets respond badly to that because they're hoping rate cuts will drive future growth from here. And that's led to this sort of increased correlation over the last 3 years. That does not to say that every single sort of move is in lockstep. There are moments where they do their own thing. But what we're seeing is, in the sort of broad risk on, risk off moments, bonds and equities do remain much higher correlation than we've seen, say, maybe in the 2010s.
Fine. And just on that as well, I take it the tariffs, that's not going to be helpful for an inflationary environment in the US, because presumably things are going to get more expensive. Is that sort of partly the reason why they were behaving the way they were?
Yeah, I mean, Trump has a lot of policies. I think if you distill them down into the sort of four main ones: deregulation, tariffs, his sort of approach to immigration, and then his views surrounding tax and tax cuts. The deregulation and the tax cuts generally pro-growth. The tariffs and his approach to immigration would certainly be more inflationary and quite sapping on growth. Sometimes to sort of describe the stagflationary, if you will, sort of low growth, higher inflation type policies. The big question mark here is what actually he implements. We've seen a huge range of numbers and outcomes tabled against different countries when it comes to tariffs. We've already seen some rowing back from those numbers. We wouldn't expect any tariffs to be final. So even if he announces something against, say, China, if they retaliated, there would be likely some sort of agreement come to, which wouldn't be overly detrimental to markets. Bear in mind that throughout Donald Trump's first term as president, he used the S&P 500 as a real bellwether for how well his term was going. Now, if we were sort of to suggest when he might be more comfortable hurting the stock market in favor of gaining some wins with his core base, it's probably earlier in his presidency. He feels certainly quite empowered right now. He's got the Senate. There will be midterms. There will be changes to that, to the sort of power structure in the states during his 4 years. So we would expect potentially to see a higher level of disruption in the nearer term. But as you sort of come towards the end of the term of presidency, he would probably be looking more pro-business, pro-growth, and to see numbers coming through in the stock markets.
Fine. And then, so at the start, you mentioned the US had a pretty strong quarter. So what will we do? We'll look at sort of what we've done in portfolios at the end of the quarter, and what we're doing sort of heading into this. But what did we do in portfolios in Q4?
So we've continued. I wouldn't say we're not very sort of maximalist in our changes. We are much more gradualist. We've continued to make changes in portfolios that we've been implementing throughout the year. We've chosen to sort of accelerate them as we come into this new year. But during the last quarter, there wasn't a wholesale changes around the presidency, for example, in part because we were fairly well positioned for it. Our general view is that there is sort of strong scope for a broadening out in the sort of equity markets, be that further down the US market cap, so less Mag 7 dominated, or more globally, so ex-US. There are certainly significant sort of points towards opportunities further afield. We've seen market breadth in the last 2 years being very tight.
Sorry, can you describe what you mean by that in terms of market breadth being tight? Sorry.
So market breadth is effectively the number of winners versus the number of losers. And what we've seen is the number of winners is effectively 7. I mean, it's
Okay.
not 7, but it's amongst the sort of 500 main stocks in the States, 7 of them have driven the bulk of the returns.
Okay.
We would expect to see that number shift. The earnings growth, which is expected from those 7 companies versus the other 493, the gap is narrowing significantly. Equally, I mentioned DeepSeek earlier and the ability for AI to be a lot cheaper potentially for companies to implement. One of the things that has been very noticeable since the announcement of sort of ChatGPT and the AI revolution is that the main companies that are winning at the moment are the suppliers of AI. And what we've not seen is a lot of people winning in the sense of using AI. We're not seeing sort of more traditional companies implementing higher productivity because of its adoption. Part of that is potentially the costs associated with it, and the costs associated with it are a double-edged sword. If the higher costs means increased profitability for those suppliers, and lower potential profitability for those users. Now, places like or technology like DeepSeek, which might bring, it's an open source platform. It gives you the opportunity to adopt part of it or all of it effectively for free, or to build on it. We would, it is not sort of tumbling down of moats that these companies have, but it is certainly a warning shot, and it does sort of suggest that bottlenecks naturally get unclogged, because when you have this supernormal profitability, there is a huge incentive to go after it.
Fine. So based on your sort of us being gradualist, what themes are we sort of carrying on with then, in terms of what are we sort of taking from last year and taking into this? What themes are we sort of, and have we sort of deviated at all from any of them?
Yeah, exactly. So in the equity book, it's certainly a broadening out, as I mentioned. That is not a new theme. In the alternatives book, we remain very pro areas that benefit from higher volatility or a sort of desynchronization in interest rate policy. So macro hedge funds that make returns by playing relative value trades against different interest rate environments. The fixed income book is probably the one that we've made the biggest change over the last few quarters or 2 quarters. Previously, we were much more United States orientated and slightly longer duration. Since the inauguration of Trump, and some of the more recent data, especially on inflation, we've shifted more towards the UK and opened our first direct position in the Eurozone for government debt. As I mentioned, a higher inflation environment typically leads to a higher stock and bond correlation. In areas like the Eurozone, where inflation is coming down a bit quicker and actually already within the target range, we feel that there is that opportunity for it to become a diversifier once again, and for that sort of correlation to break down.
Very interesting. Fair. And then if you could summarize your thoughts then in terms of in a sort of short or long form as you like, really. How do we feel about Q4 for us as a business and sort of performance wise, and how are we feeling going forward? Do we have a degree of confidence heading into the rest of 2025 around the markets, or are we sort of cautiously sort of keeping some powder dry?
No, I mean, we are fully invested. Our view is that what has happened over the last 6 months has increased the maybe the likelihood of these sort of fat tails, but they're both upside and downside. However, the sort of core or the base load in fundamentals at the moment is very strong. You know, the US corporate health is good. Consumers still can have unstretched balance sheets. They've been sort of deleveraging, especially when it comes to stuff like mortgages. There is a lot of opportunity out there to make money, but the flip side of that is that valuations remain quite high. Mm-hmm. We have been building up what we'd consider sort of resilience in the portfolio. We would hope to make a solid return next year rather than targeting a sort of stellar return. Because we feel that the opportunity for there to be a misstep either by a policy or a crack in the system because of this increased rates environment that we've had has increased, but it's definitely not made it into our sort of base case. As I think you've probably heard in previous conversations, you know, we believe that diversification is a great way of maintaining a sort of high gross risk. So the portfolio maintains a lot of opportunity to make money, but it keeps quite a low net risk. So when you combine them all together, you can keep the volatility of portfolios low. So when maybe something's winning or losing, there is other things offsetting it.
Fine, brilliant, great. Well, Charlie, thank you so much for your time, and thank you all for listening out there. Obviously, if you have any questions, as always, please do get in touch with us or your advisors, and we'd obviously be delighted to speak further. But until next time, thank you all very much.
Thank you very much. Cheers.